Hello, and welcome to Sisters for Financial Independence, where we talk about money, motherhood, and everything else in between. This video that I'm going to share with you today is the beginning of our Investing 101 series. Over the next few weeks, I am going to be releasing a series of videos to help you begin investing. Because while we can budget, while we can cut down, and while we can save, one of the things that we truly need to do is to start investing for ourselves, our families, and our future. It's the only way we can build generational wealth. So this series will be your guide to investing, whether it's your first time, whether you are wanting to make sure you are doing things properly, this series is for you. All the videos will be part of this playlist, so check in that playlist every so often as new videos come out, and they will be dropped in that playlist. Our first lesson is all about saving versus investing. And these words can sometimes be used interchangeably. There's a big difference between them. Saving is all about having safe, accessible funds in a place where you can access it easily in the short term. This may be within 1 to 5 years. And generally, saving has little risk, so very little returns or rewards. The big downside to saving is that your money does lose value with inflation. On the other hand, is investing. Now, investing is all about making your money grow for the long term. Because of this, you will put your money in places where they might be high risk and therefore high potential for high returns. And long term can mean anything over 5 years in this case. And because you'll be investing it in something a little bit more high risk and high return, it's likely to beat inflation. In a few lessons, we will cover risk and return so you have a more concrete idea of what that means and how that plays into your investment strategy. Now, a big part of saving and investing is really using the power of compound growth to grow your money. And compound growth is when your money grows faster because it is reinvesting its returns. And here's a chart here that shows the difference in your money growth. So your middle is your 4% interest rate and the top is 7%. So that difference means your money has grown a lot more quickly and more over time. And really, that's the power of compound growth. Now, how do you make money from investing? There's three ways. The first is the appreciation in value of your investments. And normally, this will be a stock where the company is doing well, and the difference in the initial price that you bought it at and the price when you go to sell it can mean you can make money from it. The second is through a dividend payout. So as companies become profitable, they can give back to shareholders in the form of dividends, and you'll have the option to reinvest these dividends or cash it out. Reinvesting it often and early means that money has time to grow. And lastly, it can come in the form of investment payments. This is for bonds where you will buy the debt of a company, and as a payback, that company and that borrower will pay you interest on a loan until its maturity date. And a big part of why investing is something that we all need to do is that it beats inflation. And inflation is the general rise of prices, which leads to a decline in our purchasing power. What does that mean? It means that today, if we have $100, we may be able to buy 100 items. But tomorrow, because of inflation, our $100 can only buy us 80 items. And we need to account for that and plan for that accordingly. So we are now going to dive deep into our savings and investment comparison calculator. And this calculator is going to show us really the big difference between saving and investing. You can find the link to this calculator in the lesson text. Just look all the way to the bottom and you'll see it there. I highly recommend you play around with it, try it out so you can see the difference in numbers. For this exercise, we're going to do a starting year of this year because this is the year where we will save and invest more. We'll do an ending year of 2061, so we have 40 years for our money to grow. So case one will be our savings, and case two will be our investing. And we are going to keep mostly everything the same. Starting balance of 1,000 for both. We're starting contributions this year, the year 2021. We'll also do contributions at around 2,000 a year, and we're going to contribute for 20 years. But the big difference is our annual return. For our case one, we're going to do 0.05%. And this is currently the savings rate you'll find for many of the high yield savings account. And we'll also do a conservative of 6% for our case two, which is our investments. Now, the stock market has been growing steadily the past few years, so the returns have been a little bit higher.
around maybe 8, 9, 10% in the past few years. But for this exercise, we'll just do conservative 6%. We'll still see a big difference. We'll do a quick calculation here, and this is where we're going to see it. So first year, same thing. We're doing a balance of 1,000, contributing 2,000 for both of them. But this is where we start seeing the big difference between saving and investing. So we do this for 20 years, and in 20, this is our current and totals. So our savings, we have around 41,200, and our investments, we have around 76,778. Now, this is the year where we stop contributing, but the money continues to grow, right? So 2041, we go to 2061, so 20 more years where the money continues to grow. If you look at your savings for case one, you'll see that our money has not grown as much. Actually, in the last 20 years, we've only gained around $400 more. But look at the difference in our savings. That 6% interest rate or rate of return has really grown our money. In here, from 2041, we were at around $76,000. And at the end of 2061, we are at around $246,000. And this is really the power of compound interest. You'll also notice that the sooner you start, the sooner you can kind of create that money ball, and it keeps growing for you.
I highly recommend that you take a look at the calculator, plug in some numbers, see what it calculates up to, and see the true difference between saving and investing. Now, as I am re-recording part of this video, it is now 2024. We are still in a high interest rate environment, and a high interest rate environment does favor some savers because high yield savings accounts as well as CDs are a little bit higher in the 4% to 5% range. But in the next few years, we will not see that. So if you keep your money in just savings accounts, you will not be earning as much. So you need to start thinking about investing for the long term, because come next year or the year after, putting your money into a savings account will not yield you as much. Of course, savings is important for those short-term goals. You want it to be safe and you want it to be easily liquidable. The downside of putting your money in investments is that it is not easy to liquidate. Yes, you can sell it, but you might have to pay a penalty. If it's locked up in a retirement account, you might also lose some gains. Sit down to figure out what your goals are, because you want to be doing both. You want savings and investments so that you plan ahead for short-term as well as long-term goals. Don't forget to subscribe so that you get updates on the playlist and you get updates on the videos that come up for this Investing 101 series. The video playlist is available here. And if you need help with your budget so you create some buffer room and you have more to save and invest, this video on budgeting tips can help you with that. And I will see you in the next video. Bye.